We're super excited to be able to be together again. It's actually been 4 years since we've been able to do this. And in the interim, we've had our 20th anniversary from when we started the company. And so we're going to celebrate it COVID style because it was actually last year. So we're going to celebrate the anniversary this year. For those of you that don't know me, I'm Will Verity. I started this business with my wife Paula a few years back, and then my brother John joined me, thankfully, a few years later. So I thought since it's our 20th anniversary, I'd share a little bit about how we got here. We don't normally talk about ourselves necessarily, but I thought we'll indulge you just for a few minutes to give you a little background on how this all came to be. So back in 1985, my parents, Bill and Peggy Verity, and John's parents, moved to Beaufort from Ohio, and I think they would tell you it was the best thing they ever did. They loved the Low Country. They had a wonderful 15-year period here, and unfortunately in 1999 my mom passed away and my dad was here by himself, and we were living in Cincinnati, and we sort of had some flexibility, and we thought, why don't we go down for a year, help my dad out, see what it's like, have a family adventure, and we'll see what happens. So we came in August of 2001, right before 9/11. We brought our young family, and they were not at all sure about this idea. They were kindergarten, third grade, and fifth grade, I think. So we put them into Beaufort Academy. We were here for about a month, as I said, before 9/11. And 9/11 kind of reshaped how we thought about our life and our future. And we thought, wow, if we could figure out how to stay here and raise our kids in this incredibly beautiful, friendly, wonderful environment, that would be amazing. And so, long and short, we decided to start Verity Investment Partners in order to be able to do that. And we started in February of 2002. We had 3 young kids that we needed to support, and we had no clients, we had no prospects, we had no track record. I think my dad at the time would have said we had no sense, but we decided to forge ahead anyway. And after our first year in business, we had $4,297 of revenue. So we were off to a incredible, roaring start. I mean, you really couldn't put it any other way, I don't think. So that was about the time that my dad said, you know, you want to have lunch sometime? And I said, sure. And we were having lunch, and you know, right at the end, you can tell he wants to ask me something. He's like, do you really think this is going to work? Like, is this a good idea? And I said, yeah, I think it is. Anyway, so then we had a few breaks along the way, and the first break came from Malcolm Goodrich. I don't know how many of you know Malcolm, but I ran into Malcolm at a chamber event, and I told him what we were doing, and he took an immediate interest in trying to help us. And he said, we're looking for someone to manage the endowment for the Beaufort Boys and Girls Club, and I'd like you to be in the running. And I thought, well, you know, I'll even hear from him again. Sure enough, the next morning he called and put us in the running. There were about 6 firms that did a dog and pony show for the endowment for the Boys and Girls Club, and they selected us. And that was our very first client in Beaufort, was the Beaufort Boys and Girls Club. And because of his willingness to take a risk and to go out on a limb, you know, he really got us started. So I'm very thankful to Malcolm for taking a chance on us, giving us really our first break. And that led to a number of other clients that served on the committee for the Boys and Girls Club Investment Committee. And so one thing sort of led to another. Our next big break came from Wyatt and Sally Pringle, and their daughters are here tonight. In the second year that we were in business, I got a call from Wyatt, and he said, Will, could you meet with me? And I said, of course. I'd known him sort of casually, but not super well. And he said, my health is failing. I don't know how long I have to live, and I want to feel confident that my wife Sally is going to be taken care of, and that there's something there for my kids, you know, over time. And he had been a very successful businessman. He was a pillar of the community. So it was an incredible honor to me that he called, that he would trust me. And I said, of course, Wyatt, this would be a great honor to help you. And before the meeting ended, he said, well, there's just one thing. Be sure you don't let Sally run out of money. And so I said, well, we're going to do our very best. And Sally, her birthday would be yesterday. I think she would have been 92. So she passed away in January. I think she came to every one of these meetings. And what's that? Free wine, yeah. spoken like a daughter. Go Sally, and I'm happy to report she did not run out of money, so that's a good thing. The next break we got was John and Vicki moved to Beaufort from Chicago, and John joined us in 2006, and that's just been an incredible blessing to have a chance to work with my older brother in a way that I could have never imagined. We've had just a wonderful working relationship. We've never had an argument of any kind. Just to the contrary, it's brought us closer, and it's been an incredible blessing for me to have that period with John. And
for me too.
Thank you. And then Andy Anderson, who's standing in the back of the room, was a classmate of mine at business school, and he joined soon thereafter as a partner. He was doing a lot of other things as well, but he's been incredibly helpful in our journey in helping us build this business, think through who we need to hire, think through a whole host of issues. So his support and friendship has also been just vital to the development of this business. So thank you, John and Andy. So luckily, the first year was not an indicator of everything there was to come. You can see, here's year one, doesn't even show up on there. Year two, we made it to 36,000 of revenue, 3 kids to support. This is revenue, not profit, by the way. So it's been an interesting journey, and we have gotten to this point really because of you guys. So many wonderful clients have put their faith in us, and we are so thankful for that. And it's just been an incredible journey. It's been an amazing group of friends that we've developed with all of you, and we have clients, I believe, in 32 states now. So we're in a lot of different places. We manage about $900 million, so we're sort of getting close to $1 billion, which is, I don't think I ever envisioned that when we got started. With the first year with $4,000 of revenue, we were not thinking about anything like that, I can promise you. In the process, we've been able to build an incredible team, and I hope you get a chance to meet all of them tonight. They all have a name tag that looks kind of like this. About a year ago, we took this photo. There were 12 of us in the photo. Andy is missing, but this was our team at that time. And all these folks are here tonight. And then in the last 3 months or so, we've added 3 more team members. So Cindy, you may have met out front, was greeting you as you came in. Keith Bosco started 2 weeks ago. He's going to be a trader for us. And Meredith just graduated with a degree in financial planning and is going to join our financial planning team and starts in 2 weeks from now. So where are you, Meredith? There she is. So anyway, hopefully you guys get a chance to meet all of our team members. We've got just an amazing team. I feel so fortunate to have them. I didn't have a photo of Andy in the, he wasn't here for that photo that we took last summer, so I thought, well, I can dig up a photo. And I just want to point out that I took this picture, and that fish is not quite as big as it looks like it is. He knows the secret is you hold it way out here, and it makes it look like the fish is a whale, basically. But it was a pretty good fish. Andy and I have had a lot of fun fishing together all over the place and doing other things as well. So anyway, I thought it'd be fun just to provide a little bit of a background as to how we got here, to thank all of you for making that possible, and to thank our incredible team for coming along for the journey. So I thought I'd have the investment team. To be on our investment team until recently, you had to be named Michael. So we have we have Michael, Mick, and Mike, so we have variations on the theme. And then we hired Keith, and so we've broken the whole thing. But anyway, you're going to get to hear from the 3 Michaels next.
I'm not sure what this furry thing is on the end of the microphone, Will. Did you put that on there?
That's John did that.
Okay. Oh, John, that's for you. Great. All right. I'll make sure. Oh, I will. Thank you. Well, welcome everyone, and thank you, Will. We don't get out very often as part of the investment team. They kind of keep us behind the curtain. We're slaving away, working on the strategy. We have the great opportunity to hear our team talk about many of you. We know a lot of your names. We know a lot of your stories. And so it's great to make those connections and look forward to meeting many of you that we haven't met tonight. And thank you for joining us. As Will said, we're going to spend a little bit of time. I know we're limited, so there's some reservations that are needed to be met, and so we're going to keep this pretty limited. But we thought it would be helpful to talk a little bit about our investment approach this evening. And so I'm going to take a little bit of time, begin that conversation. I'm going to ask the other two Michaels, Mike and Mick, to come up and actually share with you some examples so you can see that actual approach in action. So you've probably heard us define our investment approach as our 4 jobs. Probably when you first met the company, when you meet with your advisors periodically, when we send out our newsletters, when we write information from the investment team, we're often referencing our 4 jobs. It's core to who we are and what we do. And so those 4 jobs are relatively simple on paper, a little bit harder in application. But the 4 jobs, as you see up here, number 1 is to provide a significant and reliable stream of current income. Job 2 is to grow that income each year. And we have targeted rates of which we're seeking to accomplish that. Number 3 is to have attractive long-term total returns. We know that that's important as well. And then in periods like last year, resiliency in down markets, again, is very important. We want to make money in the good years, but we want to protect it in those more challenging years. To give you a little better breakdown of how we think about this and how we control this really from an investment team is, number 1, we are very conscious of the types of companies we're investing in. We judge our companies by, as we say, their ability and their willingness to pay and grow their dividends. So that's first and foremost. If we do that really, really well, we can accomplish this goal of growing the income, paying the income, and growing the income each year. Secondly is we expect the yield on the holdings to be significant. If you look at our core income growth strategy as a whole, the yield right now is right at 3.7%. It doesn't mean that every company is yielding 3.7%. You'll see in a minute we have some that are a little bit lower yielding, could be 2% or less. We have some that are a little bit higher. But on balance, we're wanting to create that portfolio that has a very consistent level of current income. And the reason that's important is really because of you. When your advisors are working with you and they're putting together plans, whether it's planning for retirement or just planning for long-term wealth accumulation, they're using these guidelines for current income, for income growth as well, to really help you set the stage for what your life will look like. As we say, we want you to live joyfully, and this is a very big part of accomplishing that. And whether you're funding expenses, whether you're reinvesting, both are equally important from that standpoint. Ways that we control growth of income, most importantly, we're investing in companies that we expect to grow income each year. So again, we're talking to company management teams, we're doing fundamental analysis, and so our expectation with every company is that they grow their dividend. We actually forecast dividends ourselves, so we hold the team accountable to that, and so it's part of our performance metrics. Because we then convey that to the advisors, and they share that information oftentimes with you. So that's one big part of ensuring that income growth. Another is our ability to do trades that are income neutral to accretive. So when you think about, as we're trading the portfolio, if we're adding a new name, we're taking a name out, it could just be weight changes or even tax loss harvesting at times. Every trade we do, we look at the impact to your income and to your income growth. And so we're very sensitive to that. We want to make sure that whatever we're doing in the portfolio, again, is accretive to that outcome. Now, one item that you can control more than we can is whether you reinvest your dividends. Again, we have clients that they take the income off of their portfolio, and that's certainly appropriate. That's the great thing about the strategy. But for those that don't require that income today, when they reinvest that, what we find is really attractive compounding of that income over time. And again, if you're working with an advisor, they can show you the differential in that if you're investing those dividends back into the portfolio. As we look at targeted returns, we have on here 7 to 9%. We don't see ourselves in a horse race with the market. We expect to return in line generally with how the market has done historically, so that's 7 to 9%. Again, what's important for us is the creation of that income in that income growth. But what we do know through market studies is that companies that pay and grow their dividends historically have done better than companies that just pay and not grow. They've done better than companies that don't pay dividends at all. And they particularly have done better than companies that have cut their dividends. So we feel like we're playing in the right team by buying these types of companies. And additionally, because we're targeting a higher level of income, our confidence level of achieving that 7 to 9% is much higher. So again, when it comes into planning for your future, it's a very big part of our calculation. And then lastly is resiliency within the market. And there's some things that we can do to control that. There's some things that you can do to control that. We know that by investing in high quality companies, that's a great way to start. When you're investing in market leaders, they tend to weather those storms much better. We diversify the portfolio. Now, how some people define diversification may be a little bit different than how we define it. The market may define it as you need to invest in 14 different asset classes, have exposure to all these different markets. We believe you can accomplish diversification by having a stock portfolio that has large cap companies, that have mid cap companies, maybe some small. We are predominantly value oriented, but there are some growth companies. And we diversify across the economic sectors of the market. So oftentimes you hear it as consumer names, energy, financials, healthcare, industrials. There's 11 GIC sectors, and we're typically exposed to all those. So that's a great way to mitigate risk, is to have high quality companies and have them diversified through a market cycle. And now where you can help us control that is how we act within the portfolio. So for those that are spending, we match the spending with the income. And the reason that's important is you don't want to sell an asset when it's depressed. So if you're just taking the income off the portfolio, you're not really as concerned about the volatility. Where people make significant mistakes is they follow the guidance of using a total return approach to meeting their spending needs, and that works until it doesn't. And when it doesn't is when you're having to sell an asset and the market's down, you're having to sell stocks to meet your spending needs, and that makes it very difficult to recover from those lows of the market. And for those that aren't spending, the ability to reinvest. So when the market's down, we see that as stocks are on sale. The good news is, the market has always recovered. We've had some really tough times, and we've had to remind clients of that at times over the last 5 years since I've been here, when we've had some significant drawdowns. But we do know the market always recovers. And so, again, the ability to reinvest that in a down cycle is really attractive. So that's just a brief overview. We thought it would be helpful for you, again, to get some examples and to see this in action. And so I'm going to turn it over to Mick.
I'm going to talk about Texas Instruments. Now, when you think of Texas Instruments, do you think calculators? I mean, is that what most people think? Okay, so I honestly think it's almost like a marketing thing for them. I don't really know that they make that much money off of it, and it's a pretty narrow slice of what they actually do. What they actually do is, if you look at these pictures here, this is just kind of a narrow subset of probably how much of how Texas Instruments is actually in your everyday lives. I mean, who here feels like an IT administrator when you get a new car? Yeah. Or you get a new appliance. Refrigerators talk to you now. A lot of that has to do with the advancement in chips and the content in chips that you're finding in all kinds of different products these days. Now, Michael talked about the 4 jobs, and what we're going to do is we're going to get down a bit into the nitty-gritty here as we talk about the building blocks towards those 4 jobs as we select securities here. So, job 1 here, is to generate income. Now, the current dividend on Texas Instruments is 3%, a little bit less than double what the market's paying there. A couple things we look at is we're always focused on the ability and the commitment to paying that dividend. So a couple of words about the ability here. This is kind of a narrow subset of a lot of some of the metrics that we that we look at when it comes to the companies. We're looking for things like a dividend payout ratio that's reasonable relative to its industry. You know, the dividend payout ratio is the percentage of the dividend, or sorry, rather the percentage of the earnings that you're getting paid out as an equity investor in the company. Another key feature that we're looking at is the percentage of free cash flow. Now, free cash is, you know, I don't want to go too far into the weeds here, but free cash is the actual cash the company's getting, you know, after they pay their bills. You know, and out of that, they're determining, okay, what do we want to do with this free cash? Do we want to invest back in the business? Do we want to pay down debt? Do we want to buy back shares? And in our case, you know, for you all, you know, how much of that do we want to return in dividends here? So we're looking for a healthy level of dividend return out of that free cash here. We're also looking for, you know, pristine balance sheets. It doesn't get much better than what you're looking at here. Won't go too much into the weeds, but a net debt to EBITDA, essentially that's all of your debt. You minus out all your cash, and then you're looking at essentially your core earnings, and you want to see, you know, typically something that is less than 2. Well, these guys have so much cash on their balance sheet, it's 0. In addition to that, it's an A+ credit rating, which means this company has a lot of flexibility. Now, obviously, you know, as a dividend growth company, we want to see that dividend obviously grow. You know, a couple of things here. This kind of goes back to the commitment to the dividend. It dovetails nicely with that. Now, you know, when you look at the dividend growth tenure here, it's 19 years, and the reason why that's pretty important is because when you think about it, during these last 19 years, we've had a couple of major events where companies, you know, had every excuse in the world to go flat on their dividend or cut. What's great about this company is they didn't. You know, you have the global financial crisis and you had COVID, right? In this case, their dividends actually were right around 10% growth during that period. So that demonstrates a real commitment to not only the dividend, but growing that dividend. In fact, over the last 5 years, dividend growth has averaged about 17% here. Also, they have a stated dividend policy. Now, you don't always see that with companies. You know, in my experience, I'd say it's about 50-50 that companies have a stated dividend policy, which is something we really like to see because it gives us more confidence in figuring out what that dividend might be. In this case, this is a company that is very focused on free cash flow. They think it's the hallmark of a good company, focused on long-term free cash flow, which is, you know, that's music to our ears. And in this case, they have a stated dividend that their policy around that dividend where they're going to return 40 to 80% of that free cash, depending on the year. And over and above this, you really don't see this with very many companies, is they actually have an annual capital management presentation where they present to investors exactly how they're managing your money, you know, exactly how they're managing your capital in the business. So very transparent. So it's very helpful for folks like us. You know, job number 3 here is to provide capital appreciation. You know, you're looking at a company that over the last 20 years, essentially the time frame in which they've been growing their dividend, they've been averaging about a 14% annualized return versus the market's 10% return. Now, you know, obviously this is in the past, but you know, to kind of think about you know, why we're confident about this company in the future, you have a very strong management team that delivers on what they say they're going to do. So a lot of confidence amongst investors. You know, consequently, you know, when you think about the numbers that back up how management is done, you see a 17% earnings growth rate, which kind of ties into, you know, that 17% annual dividend growth that we saw in the last slide. And you also have, when you go into the fundamentals of this company, you know, back to what we were talking about as far as being a calculator company, you know, obviously they're not. You know, we've discussed that. We've covered that ground. In fact, you know, they identified many years ago that the high growth areas of the semiconductor industry were going to be in autos and industrials, and you know, we've really seen that play out. So this company's been investing around that for years, around manufacturing towards that for years, and it's really paid off nicely. And consequently, it's backed up returns for investors here. Right now, that's just you know, my price target. on this particular company after modeling out, what the future, it may look like here. And I see about, a little bit less than 20% upside here over the next 12 to 18 months, is what we're kind of targeting. And finally, job 4, what we want to see is nice preservation of capital. When you look at this company, this is just a snapshot of what we see routinely with Texas Instruments and a number of the companies that are in your portfolio. It outperformed handily in the last year. Obviously we had a big down year in the market. The S&P was down about 18%. This company was down half of that. So it's a testament to investors' comfort with this particular company and the defensive characteristics that it also has here. So in terms of defensive characteristics, you got a company that manages or generates about 70% of its revenues internally. What that does is that allows them to be very close to their customer. It also allows them to manage inventory. That's been one of the hallmarks of this industry, is you have kind of a boom and bust as chip inventories get out of whack with the state of the economy. These guys do a great job of managing that inventory. They also have a very broad portfolio with long-lived technology. So they're not going to be stuck with chips that are cutting edge today, but 6 months from now they won't be. So that's not how this company works. And then finally, a real manufacturing advantage. I don't know if there's any engineers in the room, but real manufacturing advantage as it relates to how they make their chips. In fact, a 40% difference in cost from by manufacturing this 300 millimeter wafer, about that size, versus 200 millimeter. So, for all these reasons, this is kind of backs up why we like this company and why we really, why we want it in your portfolios. So I hope this gives you kind of an idea of how we at the individual security level, we're coming up with stock picks for your portfolio using the 4 jobs. Obviously, that builds into the 4 jobs at the portfolio level for you. And with that, I'm not going to say the name of the company. I promise I won't. I'm going to hand it on over to Mike here.
Now I'd like to reinforce the 4 jobs framework that Mick outlined before by double-clicking on another example. This company is likely familiar to all of you, especially with the pandemic, and it has its roots from right up the road in North Carolina. I have a picture right up here of the first store. Does anybody want to venture a guess of maybe the company that I'm referring to? Somebody said Lowe's, I heard it. Yep, this is Lowe's. So what I've included off on the right here is an abbreviated timeline. And as you can see, it's a long history. It opened its first store as a general store in 1921. A little over 25 years later, it opened its second store and started to focus more on home improvement retail. About a decade after that, it became a publicly traded company. And then if you fast forward to the end of last year, the company generated over $90 billion in sales from over 1,700 stores in the US. The takeaway from the timeline is that Lowe's has had a long and enduring history. If you think about all the things that have happened over those 100 years, and even more recently in the 60 years since it was a public company, the company and its management team has had to endure and overcome a lot of things. Think the high inflations of the 1970s, the dot-com boom and bust around the 2000s, the terrorist attack in 2001, the great financial crisis, which actually was housing driven, and then more recently the global pandemic. So while history does not guarantee similar future success, I think it does provide context, and it's something that we consider as we do our analysis. So now on to the 4 jobs. The first job, which we talked about, is generating income. Lowe's currently yields 2%, which is above the market yield of 1.7%. If you say that a little bit differently, if you invested $100 today in Lowe's, you can expect to get about $2 in dividends over the next year, versus that same investment in the S&P 500 would give you about $1.70. So it's generating income above the market. And then the 3 other metrics I have up there below that are really about ways to assess the reliability of that income. The first one is dividend policy and the dividend payout, and Mick alluded to this a little bit earlier, but the payout ratio essentially says how much of the dividends are being paid out of their current earnings. And so generally, if the earnings can be more stable throughout economic cycles, that ratio can be higher. We feel confident in 35% that it gives enough headroom for the company to be able to pay their dividend and continue to increase that dividend if any unforeseen events crop up. The other two metrics below that relate to debt. And that's important because debt holders are always paid first. So we like to make sure that the company isn't over leveraged, and as you can see by the metrics up there, they're below their leverage target. And the second thing is their credit rating. We always like to have companies to have good credit ratings so that in the event of difficult times that they're able to go to the debt market and raise additional capital. The second job is growing that income. Mick alluded to this as well in terms of we've assessed the ability, but it's also important for the companies to have a willingness to be able to pay and grow that dividend. I mentioned before that Lowe's became a public company in 1961. It's paid a dividend every year since then and increased it every year. So they have over 60 years of continually increasing their dividend. That actually qualifies them as being a dividend king, meaning they've had 50 years of increasing their dividend, and only I think there's fewer than 50 companies today that meet that qualification. So that's really important. Additionally, if you kind of focus more recently, the company raised their dividend last year by over 30%. And if you kind of widen that lens a little bit, over the last 5 years, they raised their dividend by over 20% each of the last 5 years. So pretty impressive. The chart that I have up there, the orange bars are the actual dividends per share over the last 10 years. And we like to see a stair-step fashion up and to the right. The light blue line just kind of shows the annual growth percentage. And almost every year it's above the 10%. The only year that wasn't was during the pandemic. So pretty good, strong dividend growth profile. If we look forward, we believe that the company will be able to raise their dividend by over 10%, and that's roughly in line with what Wall Street analysts are considering as well. The next job, the third job, relates to providing capital appreciation potential. And we use valuation metrics to determine whether a security looks expensive or if it looks cheap. If anybody's bought a house recently or even in their lifetime, you also use a valuation metric usually, price per square foot. In our industry, we tend to use evaluation metrics called price to earnings, or PE. And what I've included there, the top chart is relative to itself. And on the bottom chart, there are price to PE multiples versus the broader market, which is on the bottom, and the orange line is versus its competitor. The key takeaway, though, is that across all of these metrics, we believe that Lowe's is undervalued and provides upside potential. Our analysis, we believe that the valuation should be in the mid $240 range, and that provides a little bit more than a 15% upside potential there. So it does hit on the third job as well. Lastly is the fourth job, which is downside protection. One of the metrics that frequently gets used in the investment industry is beta, and essentially what that means is just how volatile is the stock price in comparison to the volatility of the broader market. Generally, that number, that adjusted beta number up there, we like to see if it's below 1, that means that it's less volatile than the market. So that's a positive. And then lastly, we believe that in order to protect downside as well, having near-term and medium-term catalysts or events that can drive value help protect downside. So I just included a few specific examples to Lowe's that I believe over the next 12 to 18 months will help protect its downside. And I'd be happy to talk about those in more detail, after a few drinks or whatever. But I'm reading the room right now, so I'm getting between you and drinks. So I will wrap up. But I do think, Mick shared an example. I shared an example. I think that where the real magic is made is when you can put a bunch of these securities together in a portfolio. And I'd like to turn it back over to Michael to talk about how our strategies have done over the last several years. So
It's, you know, we're very fortunate to have an unbelievable team. You know, we currently oversee actively 80 securities across the three of us. We have different sectors that we carry. And so as you can imagine, it's a lot of work. You know, when you're doing this level of detail with the companies, we maintain investment rationales, we're talking to company management, we're doing conferences. It takes a lot to keep up with all these companies on your behalf. You know, it's not good enough just to buy something and let it sit there forever. There are companies that we hold for a long time, and we want to be long-term buyers of companies, but you also have to kind of, you know, tend to the garden on occasion. We're very fortunate, and just want to take a minute to recognize these guys and just the firm overall. This was just recently announced, and we haven't even promoted this yet or published this yet. But one of the largest databases of managers like ourselves is Zephyr PSN. So they maintain a database of thousands of investment managers like us. We were just notified a couple of weeks ago that we had won several awards as a PSN Top Gun. You can see CIG, which is our core income growth strategy, won Manager of the Decade for a global equity universe. And again, I think there are 8,000 different return sets that are in that. Won Bull Bear Global Equity Universe, 1-star Global Equity, our Enhanced Yield, which is EY, 2 stars, the Mega Cap Universe, and then our Focused Dividend Growth, Bull Bear, and 3-star status for Socially Responsible Universe. So this is really due to a lot of the work that's being done behind the scenes. You see it in your portfolios. You know, we've had a really good year last year. It's challenging when you define a good year and you're down a couple of percent. But when that's relative to the market, that's down 18%. And we hear stories of people that were down much more than that, 20 or 30%. We feel really good about that. So I want to take a few minutes for Q&A. I know we've got some time afterwards, but if there are some easy questions, I'll take them. If they're hard, I'll pass them over to these guys. If they're really hard, I'll give them to Will and see how he does with it. But I don't know if there's any questions about the market, the economy. We love this. We're passionate about it. We could talk about it all day long. I know that's not what you want. And so I will ask, though, are there any questions that we could entertain?
What do you see in the near term? What do you think is going to happen?
Hold on. I think I left my crystal ball back here. Let me, somewhere. It's a really interesting time in the market. There seems to be a disconnect in terms of the reality of what is happening right now and how the market is reacting to it in the near term. There are kind of two ways that gets resolved. Either there's going to be a reset in market expectations, which most likely would be a downturn in the market, or the market will just look through it and we'll just trade in a very tight range bound for the next 12, 24, 36 months, because it's going to take a significant amount of time to have the financial impact of the kind of the monetary tightening that is happening right now, and the impact of inflation on the economy, and just GDP growth for the U.S. and really globally. So we think the market will stay range bound, short of some sort of exogenous event that might drive things lower. So call it 3,800 to 4,200 on the S&P. If we start seeing some dislocation, you could see it go back to 35, 36. If there's some sort of significant event, you could see it go down to 3,200. It's kind of what we look at and think about. So I don't see it going to 4,500 or 5. I hope I'm wrong, but it's just hard to make that case right now given what we're facing from an economic perspective. Great question, John. I love it. I put that in his pocket before I got up here, so that was a good one. Yes?
I was hearing before from my prior advisor before I joined your company that an election year is usually a very uncertain time.
Mm-hmm.
And obviously 2024 is, once again, is going to be another unpredictable, I should say,
Yes.
election year.
Yeah.
And what do you think is going to happen? I know you don't have a crystal ball.
Yeah.
I understand that. But what do you think 2024 will look like?
Will, I think this is one for you. You know, we kind of grew up in the South, not talking about politics and religion, but you know, it is obviously something that you know we consider when we're thinking about the portfolio. You're right. You know, those tend to be volatile times. As we know, these seem to be extremely volatile times from a political perspective. It's really just hard to predict. I mean, it's sad from a state of the nation that you've got two apparent candidates representing the two predominant parties that no one wants to elect. I mean, it's hard to put your head around that. And so, you know, it's interesting, you know, and I won't elaborate on this too much, but we spent so much time using history as a guideline for how we think about the portfolio. And so even the last several years during this inflationary environment, we were spending a lot of time saying, okay, is inflation going to be transitory? We were looking at the social environment, we were looking at the political environment, and there were so many parallels to the late 60s, early 70s. And so, you know, I think we're just going to continue to have a lot of disruption politically, unfortunately. And, you know, it's unfortunate. I don't know that it matters which candidate wins. It's not going to be, it's not going to be a great environment just from a political perspective or really a social perspective. The market can still do well in spite of that. You know, as we know, when there's a stalemate in DC is one of the best things that happens for the market because they're not making stupid decisions. So we can hope for that. We can hope for a stalemate would be a good outcome. But yeah, so the economy can do well, the market can do well, but socially, politically, I think it's going to continue to be challenging for a while. Yes.
So when you get together for your quarterly meetings, how are you checking what companies are qualifying and are performing well in terms of meeting those 4 job criteria that you have? And how are you checking yourselves to be sure you're open for something new moving into that space or something you counted on is moving out?
Wow, what a great question. Thank you. So I'll tell you a little bit about our meeting cadence, and I'll go into a little more detail. We meet every morning. We do a morning huddle, and the design of that is, hey, what's actionable for the day? What's happening within our companies? What's happening in the market? Once a week, we do a little deeper dive meeting. So we spend about an hour, hour and a half, where we're going a little bit further detail into the portfolio, talking about individual companies, markets. Once a quarter, we do an investment committee meeting, and that's where we get all hands on deck, and we're looking at attribution, we're kind of what's driving performance. We have a screening process for determining our investable universe. So not to get again too detailed, but companies have to pay a dividend. They have to grow that dividend above a certain rate, certain liquidity requirements. That produces a universe of about 450 companies. So our job, my charge to these guys is that we want our best ideas at the table at all times. So there are no sacred cows that exist in the portfolio. So if something were to fall out of the screen for some reason, we're evaluating that. It could be something simple. We have a minimum yield target of 1%. We have had companies that have gone below that because their appreciation has outpaced their dividend growth, which is not a bad thing. But we do evaluate that, and so if there's a violation of our screen, that causes or requires an approval to keep that in the portfolio. But we're always looking at, again, best ideas. Mike was showing earlier, sometimes you can look at two companies that are kind of very similar in an industry and make comparisons. Sometimes they're completely different. Right now we're spending a lot of time in the interest rate environment thinking about financials and REITs and utilities, and there's a lot that goes into it. But yeah, so we measure them to those 4 jobs. Again, that willingness and ability to pay that dividend. We want to ensure that they can grow it, and valuation matters in terms of long-term appreciation and preservation. Yes?
Does short-term capital gains enter into your thinking if you're looking to sell?
It does, and we want to sit alongside the relationship managers, the advisors who are sitting alongside each of you as a partner. And so if there are things that we're doing in the portfolio that have the potential to create a short-term gain for a taxable client, we want to understand that. we want to calculate that into the cost of that trade. So if it's one thing to say the income is going to be neutral to accretive, but if you then factor in a short-term capital gain, then actually what was the impact to the client? You know, one of our core values is to put clients first. So everything we think about, we want to think about it in that lens. And so yeah, it does factor in, and if there are cases, whether it's short-term capital gains or even long-term capital gains that are specific to the client, then we manage it at the client level. You know, if we're fearful that there's a fundamental issue with a company, they're like, hey, listen, we need to get out of this. This is deteriorating, then we'd be more willing to accept that. But if it's just simply doing some rebalancing or making some slight changes, then we'll wait till that short term turns into long term, typically. All right, getting full. As I said, we'll be here, so once we get something to drink, welcome to ask more questions. Thank y'all.
You earned it.
Thank you.
Nice work. You can see why we're super proud of our investment team. Feel very fortunate to have these guys. You know, we're here in this small town of Beaufort and Bluffton, and we've been able to find world-class investment professionals to fill our team, and we just feel so fortunate about that. So I thought you guys did a great job. They're available after this. We have a lot more wine, a lot more food. Hope you guys will stick around, and thanks again for being here. Thanks for being clients. Thanks for supporting us, and we look forward to visiting after the presentation. So thanks.